Aditya Khemka, fund manager at Incred Asset Management, joins us on the show. Incidentally, Aditya, kudos, because I was looking at some of the data points of funds which are doing very well. And I distinctly remember amongst the most decorated funds about 5-6 years ago used to be DSPMF, and you used to manage that fund. And I think 2024, your fund on the PMS side is amongst the best performing, or probably the top performing PMS scheme as well. So kudos on all of that, Aditya.
Thanks, Neeraj.
My question to you, therefore, is, Aditya, having seen the performance that you have in 2024, right? How do you feel about healthcare currently for the year, of course, and also for the near term, considering that there is a very important earnings season in front of us, wherein sectors which will do well, and there might be a handful which will do well, might actually get a lot of attention, and healthcare might be that.
Yeah. So I think, Neeraj, if you look at the broader market earnings, I think clearly banks, autos, cyclicals are not going to do well in the coming earnings season as well. The broader economy has shown a consumption slowdown. There is a capex slowdown, and that basically will impact all the cyclicals that we look at. Healthcare being slightly non-discretionary in nature in terms of consumption, slightly being non-voluntary consumption. I would sense that healthcare will continue to do better than the broader market in the next 2 to 4 quarters is our call. And we also understand that the valuation metrics around healthcare, specifically some healthcare delivery companies, is far more favorable to the investor than the broader market. So a mix of better earning growth and more reasonable valuations is what has done well for the sector in the past 12 months, and that still continues to be the case.
Okay. There is a fair degree of resilience that pharma stocks are showing, but for the fact, of course, the ones which are getting US FDA, issues, that is separate. But in fact, we've seen a clutch of EIRs as well, and some clearances too. So Aditya, would you reckon that the price move and the resilience and the quarterly performance points towards a near-term strong performance fundamentally as well? And would there be first amongst equals in healthcare? Because as we always speak about, right, there are 4 or 5 facets now to healthcare. And therefore, you can't paint everybody with the same brush within the space as well.
Well, that's true. I think the first amongst equals within healthcare will be the diagnostic space. I think the volume growth there is being above what people are expecting, and more importantly, people were expecting a price decline given the entry of online players in diagnostics, but what we have seen is actually a price uptick post entry of online players in diagnostics. So I think that will continue to outshine the other segments of healthcare. That should be followed by hospitals, where we are seeing continuously improving occupancy rates and ARPOBs. So that should continue to be the case. And then followed by branded generics and API players. And I think unbranded generics now don't have enough fuel to sort of outpace the market. So that is how we look at the healthcare space. In terms of price resilience, I think, again, it's the valuations, the margin of safety that these stocks and this kind of earnings growth offers you, which reflects in price resilience of these stocks.
Okay. Aditya, this is Harsh also joining in. Want to focus in on what would be the key trends with regard to healthcare going into 2025. You've seen some bit of consolidation, which has, at least in the hospital space. What do you believe will be the key trends both in diagnostics in 2025? What will be the triggers, and what are your expectations from 2025?
So I think consolidation in the healthcare delivery market, be it diagnostic or hospitals, will continue simply because too many hospitals and too many diagnostic centers opened up during COVID. And now they have realized that it's just not a business where, you can open a couple of centers and be profitable and, happily survive. There is bound to be some consolidation within the organized and the unorganized players. Having said that, that consolidation will also help in improving standards of healthcare that is being offered. And the pricing will also probably improve, because end of the day, it is a business where, money can be made by improving pricing slightly. You have to pass on inflation to the customers. So I think the key trend that you will see playing out in 2025 will be twofold. One, on the healthcare delivery space, you'll see continued consolidation, but pricing improvement in terms of the pricing of the services and products. And two, you will see some margin pressures on the product companies, which are your unbranded generics API companies, because what we understand is that the raw material prices coming in from China have started to go up after 1.5 years of decline now. So you will see some margin pressures, gross margin pressures on companies that do manufacturing of generic products.
Interesting you say that, Aditya, because you have so many moving parts with regard to pharma. You have the Biosecure Act in the pipeline. You have a new president coming in, and of course, then you have China, along with the play on US tariffs. In your view, what's the best way to play pharma, therefore, outside of healthcare? I know you're skewed towards healthcare at this point, but what's the best way to play pharma?
So the best way to play pharma is to play two buckets. Number one is to play the branded generic guys. So your Torrents, your Ipcas, your Alchems, your Indocos, your JV Chemicals, and so many other stocks which are focused more on branded generic players. Because these guys have pricing power. So even if there is inflation in raw material costs, these guys have the ability to increase the prices of brands and increase and sort of pass on that inflation to the customer. Whereas the guys who are in unbranded generic markets cannot really do that because it's the competition decides the pricing there, not really your raw material cost. So that is one way to play it. The second way to play it is to play it through CDMO players, whose largely CDMO business comes from the innovator players. So players like Newland Laboratories, Hycal, players like Syngene, Vimta Labs. These are guys who get more of their revenue from innovators, and hence when there is inflation in the marketplace, they have the ability, and these are services companies, so they have the ability to pass on that inflation to the customer in terms of billing rates.
Aditya, one final question really, and maybe it stems from some insights that are coming through from the chemical space, but I wonder if some of it could be true for select compounds in healthcare or pharma as well. There is talk of how there has been, to a large extent in a lot of places, destocking, and if China were to stimulate their economy enough, then some of the chemicals, some of the APIs, what have you, that they might be dumping across the world or across the Asia Pacific region might be used internally because there is not enough stocking available. The pricing globally of select compounds, maybe select APIs, etc., might go up. It's certainly being seen and spoken about in chemicals. Is there something like that happening in pharmaceuticals which could have an impact on Indian pharma exporters?
Yeah. So see, many of these chemicals, Neeraj, are also inputs for pharmaceutical products.
Okay.
If the chemical prices go up, then the input cost for pharmaceutical goes up. And that is what we saw between FY21 to 23 during COVID, when China had a zero COVID policy. China was not able to sell these products to the other markets. And the local manufacturers of those markets started to increase their product prices because their largest competitor, which was China, was out of the market for a different reason. So what we are speculating here is that if China stops selling outside because the domestic consumption goes up, what happened during COVID is that there was no domestic consumption, but they were not able to sell outside. But even in that case, the domestic players increased the prices who were competing with China, and the pharma industry ended up getting hurt because they were buying the raw material at a higher price, and their ability to pass on to their customer is just limited. So I would say that if raw material prices or chemical prices go up, for the unbranded guys who don't have the ability to reprice their offerings to their customers, or whose pricing is determined by the competition, not really by any brand, those guys will have the toughest time.
Okay. Okay. Well noted. Aditya, good to talk to you today. Keep up the great performance, and thanks so much for sharing your insights.